Hi, this is Larry Maddox. I'm the president of Horizon Advisors, a wealth management firm in Houston, Texas. Thank you for your attention this morning. I wanted to talk to you a little bit about our 2013 capital markets outlook. And just to get started with that, I thought we'd revisit what happened in 2012. Last year, real GDP grew 2.2%, which is certainly lower than we'd like, but better than no growth at all. Just showing the economy's improving. Unemployment improved from 8.5% to 7.8%. The S&P 500 on the year rose 16%. High-yield bonds rose almost 16% at 15.8%. And U.S. Treasuries, the safest of safe assets, rose at a meager 2% growth rate. So our expectations for 2013 we are sort of tempered by investor confidence remaining very fragile, and we'll go over each of these in turn. The U.S. economy is getting stronger, continues to get stronger after last year. We think we'll see a good 2013 as well. We think risk is relatively inexpensive, that is stocks and some of the higher yielding bonds, although they've all had a pretty good run up in prices, we'll show you later. Safety is very expensive. Dividend paying stocks have been bid up, and U.S. Treasury bonds are at their highest levels in a long time. So let's run through each one of these in turn. First of all, let's start confidence. The last 15 years have been a very rocky ride in stocks, as I'm sure you all know. We've had these abrupt advances and declines here, and it's just made investors very nervous. We've been through two recessions here, and again in 2009. We've had the financial crisis here in 2007. We had the dot-com bust back in 2000, and we've lately had this really wonderful surge over the past few years. Since March of 2009, which has gotten us back to near all-time highs in the S&P 500. But still, investor confidence is low. And one of the things that impacts investor confidence is our congressional leadership and our presidential leadership. These are just charts back over many years, which just show the fluctuation in presidential fortunes, and then lately we've had this just dramatic decline in congressional approval ratings, which won't come as a surprise to anybody, but I think that contributes to political gridlock as well. So this lack of investor confidence has resulted in a stampede into bonds, as we say at the top of this slide. These are net outflows into bonds here at the bottom, and net inflows into stocks at the top. So there have been enormous inflows into the bond area, and they've just increased over the last year. So we've had a ton of money go into bonds, which is was done at exactly the wrong time. As you can see, over this time period that we represented on the previous slide, the S&P 500 is up dramatically at 14.6 per year on average over the last 4 years, and the Barclays Aggregate Bond Index is up 6.1% per year over that time period. So while we've had a lot more volatility in the stock returns, certainly the end result is quite a bit better. The economy continues to grow as well. As we said earlier, our fourth quarter GDP was, I think, has been revised to 2.2% now, but actually this is the third quarter GDP. But we've basically recovered a lot of the output that we lost during the last recession, and the unemployment rate has started to fall from its highs at the bottom of or at the depths of the recession. It's actually, I think, trended up in the report we got today, which is February 1st, but it's still in a downtrend, which is good. We also have seen a recovery in housing. The first part of this slide on the left is 3 different measures of housing prices, and you can see each of them went through a substantial decline and have recently started to level off and actually tick up. So this is a good thing. Also, we're seeing an uptick in housing starts here. We had 861,000 housing starts, annualized housing starts in November of 2012, and our long-term average is about roughly 1.4 million housing starts. So you can see here in the text that the National Association of Home Builders estimates that 3 new jobs are created for every new home that is built, and returning to a normal level of construction would create a lot of new jobs, which would help on the jobs picture as well, and help the economy to recover. With all this lack of investor confidence, equity risk still remains particularly inexpensive. This is a chart of the S&P 500 over the last 20 years or so, and you can see that here at the end of 2012, the PE ratio was around 12.5% versus an average of 16.1%. We'll come back to that in a little bit, but if you can just kind of bear that in mind, stocks are. But some areas of the market are cheaper than others. This is a heat map that we've prepared. The hot areas, the red areas here, are areas that are overvalued, and the blue areas are ones that are undervalued. These are the ratio of price-earnings ratios, current price-earnings ratios relative to their long-term average. So you can see the S&P we talked about a second ago is about 23% below its average. Materials are about 5% below their average. Technology is 45% below its average. And then if you look on the defensive sectors here, technology is 100. It's 100 times its average. I mean, it's double its normal average, and utilities are also quite overvalued relative to their average S&P, or to their relative price-earnings ratios. These are the areas of the market that have been considered the safest because they've paid high dividends, and prices have been bid up respectively on those. So we think if you're going to invest in equities, you ought to be paying attention to the sectors of the market that you invest in. Safety remains very expensive. This is a Treasury yields. This is a U.S. 10-year Treasury yields. You can see that we've been in this monumental decline over the past 25 or 30 years. They're near all-time lows right now. When we prepared this slide originally in December of 2012, the Treasury yields were at 1.7. Since December, they've bounced back up to about 2%, so which is a pretty major move in the Treasury market. And basically, what's happened, these are returns for the bonds last year, and you can see that short-term Treasuries returned about 0.31%. 30-year bonds returned 2.34%, and the riskier areas of the bond market did a whole lot better than the Treasury. So emerging market debt, high yield bonds, both were the leaders here. But what that's done is compressed bond yields. You can see not only in the Treasuries, but in the in the Treasury market, you can see that 10-year yields are now 1.78%. Or actually, as I said, they're closer to 2% now, but they were 1.9% last year. Down here in the high yield section, you can see last year's yields were about 8.36%, and today they're at about 6.13%, which is a significant decrease in yields, and it very likely makes them a candidate for rising interest rates to hurt. This slide represents the impact of a 1% rise or fall in interest rates, as we're very concerned about rising interest rates. You can look here, if you had a 10-year Treasury bond and rates fell by 1%, you would make 9.1%, but they can't really go any lower than where they are now, so it's much more likely that they're going to go up. And if rates rise by 1%, you would end up with a 9.1% loss in a 10-year Treasury, what's considered the safest of safe assets. And similarly, these are the expected declines in some of these other areas of the bond market, from mortgage-backed securities through corporate bonds and muni bonds. At any rate, I think the thing to remember is when interest rates rise, bond prices decline. So we think they're significant bond market right now. So for our 2013 outlook, first thing we noted is we've got a lot of cash on the sidelines. This is cash as a percentage of total household assets here at the bottom of the slide. Company balance sheets have tremendous amounts of cash for it. They're kind of waiting on clarity from the government. We've got high household balances. This graph represents household cash balances. Plus, we had what we called year-end specials. We had, with the changes in the tax laws that we expected last year, we had accelerated asset sales as people went to sell their companies before capital gains went up. We had accelerated gifting as families made gifts to their kids in anticipation of a decline in the exemption for gift taxes. And we also had year-end special dividends and income that came out last year in advance of the increase in income tax rates from 35 to 39.6. So that's just added to the cash on the sidelines, which is that cash needs to be invested in something. Obviously, from our previous slides, it's been invested to a certain extent in bonds, and I think we're seeing some of that cash begin to move towards the stock market here in January. So we think there's been a lot of improved visibility. The economy continues to recover. Europe is beginning to stabilize a little bit. The election's been decided. I know that was on everybody's mind for most of last year. The health care law is in place now and will be here. We've got at least a temporary resolution to income tax policy, and Congress seems to be talking a little more seriously about fiscal issues, and certainly we've got to deal with the sequester and everything else, but they do seem to be moving in the direction of compromise, and hopefully that'll continue. And one of the things that we always want to do is to keep things in perspective. This is a chart of the S&P 500 index since 1900, and you can see that we are presently, if you look over here on the right-hand side, this is sort of a microcosm of one of the earlier charts that we looked at with the volatile markets that we've been in since 2000. But you can see the price-earnings ratio when we started this sideways market was 29.9%. Today it's 15.7%, and you can see that's happened every time we've had one of these sideways markets. We've had in 1963 PEs went from 19% over this long period, a 13-year period, to 12.1%, and in 1936 from 19.1 to 13.4, and of course in 1900 through 1920 it went from 13.3 to 8.8. In the Great Depression we had a little more abrupt decline, and PEs went from 18.7 to 11.4. The thing that's important here is that after they reach these new low PEs, the market tends to go up, and it's certainly done that in years past, and we expect that to happen, in the near future. We don't know when it'll start. It may have already started, but certainly we're in one of these plateau stages right now, and it certainly seems ripe to increase in the future. So our 2013 portfolio recommendations are to stay diversified, to relax. We think the U.S. economy is improving. We think adding risk opportunistically in unloved places, and in particular in the in the stock market, makes sense. We want to make sure we don't overpay for yield. Our portfolios remain very short term, so that we won't suffer with any increase in interest rates, and we think the same in the equity markets, where the yields on dividend-paying stocks have been pushed way down as well, and the prices of those stocks have been pushed way up. We think if we end up with a general recovery in the equity markets, we'll see other stocks outperform those that have been overpaid for. And we just say really invest with caution in the bond market, where what everybody's always thought is the most safe area of the market is long-term treasuries, and certainly that's not the case today based on current interest rate. So with that, we'll sign off. Thank you very much for listening. If you have any questions or comments, you're welcome to call us. Our phone number is here on this slide, 713-748-7000. Best wishes for a wonderful 2013, and we'll hope to see you soon. Thank you.